Yeah. So what I will do is not only Dodla Dairy, but also in terms of framework, how this stock is fitting in the basically the fundamental investing frameworks. I'll just talk a little bit about the framework also, and then we will discuss this stock in detail. So again, whatever work we do, nothing is a recommendation. All of us, we need to do our due diligence. But in terms of framework, so there are two parts to any kind of investing, which I do. There are two parts to it. One is managing the risk, and second is gaining the returns. And my view is always when we first manage the risk side, then the return side comes. And how to manage the risk? So idea is to look for bets where the chances of losing money is lesser. And when the chances of losing money is lesser, so typically where wealth destruction happens, it happens in companies which are very weak in nature. They just run on P&L. But when there comes about balance sheet and cash flows, they don't have. Mostly you will see these kind of companies, they run in the bull market. And when at the moment bear market comes, all of a sudden the prices fall and people wonder why prices are falling. And the key reason lies balance sheet, cash flows and all. Second, we lose money because we buy things at very, very high valuation. And we know there are enough examples, even in last 2 years, we have seen from platform companies to whatnot. There was a mad crowd going on. So even good businesses, they don't, I mean, if something is falling 50% from our buy price, where the market has hardly fallen 10-15%, then there is something wrong. So I won't say a 50% fall, is always wrong, but relative to the market, when the stocks fall 4x, 5x relative to the market, then surely there is something wrong. So this is second way how we lose money. Third, where we lose money is when we buy poor business qualities or businesses which don't have growth opportunity, where we have execution challenges. So poor business quality means anybody can enter. So like right now what is happening in diagnostic at those kind of valuation, if each and every competitor is entering, the kind of margins earlier they had, they were not able to maintain. Or we have kind of businesses where it looks value investing, but then these are sinking industries. Like if I can take off paper sector and all, from 6 years, it's there as a value investment. Even in 2016, people used to talk it as a value investment, and even now. So 6 years have passed, and it's this. So these are the places where we lose money. So if we revert, if we avoid it, we may not lose money. So if we are in a companies with strong balance sheet and cash flows with decent return ratios, and we are purchasing at fair to attractive valuation, and we are buying, decent businesses which have some strong business model and there are growth opportunities and the management is executing, we may not lose money. And then above all, if it's a clean company, clean promoter, because if this is not there, then all the other things don't make sense. So if we have to ensure that we don't lose money, these are the things which we need to look for. So whenever I look for any investment idea, at least I look that, okay, if these things are there, then okay, chances are I'm not going to lose money. And how do we look at it? So again, I'm trying to leverage a lot of resources which which is there in our community and the program, some webinars I did. So again, I'm going to our Excel format and just to check the balance sheet strength. So this is the Dodla Dairy balance sheet. And if we look how the balance sheet has transformed from 5 year back to 3 year back, 3 year back to current, we can clearly see that the borrowings are reducing and the reserves are increasing, which is a sign of a better balance sheet. The other thing is if we look at the asset side, so this was the liability side. If we look at the asset side, 50% of the asset is your basically your net block, and then you have good amount of cash and investments. So, and given it's a dairy business, little bit of inventory will be there. So nothing looks surprising. It looks good, and from a balance sheet evolution perspective or transformation, it looks better than how it was in the past. If we look in terms of cash flow, so I always say that 70% EBITDA to cash flow is like the minimal which should be there. And if we look at the current history, throughout 90% EBITDA is getting converted into cash flow. The other thing, if we look at the cash flow growth rate and free cash flow growth rate, In last 5 years, the company has, and because we have only 8 or 7 years of data, so that is why you see this number is zero. And now you would know this is a rolling 3 years. So we take 3 years and then average, we take 3 years and the average, just to ensure that, because 1 year blips can come. So this is a better way to look at it. And we can see the cash flows have grown 4x, and not only cash flow from operation, the free cash flow also has grown. And many times we don't discuss about free cash flow because there are very few companies who really generate decent free cash flows post capex. But this is a company which is generating a very good amount of free cash flow even after doing all the capex. So good free cash flow conversion despite capex and growth taken care. So good balance sheet and cash flow return ratios, it may not be very high, but see, when the company is growing, a 14-15% kind of return ratio is decent, because if it is higher than the cost of capital and if we are able to deploy money, then it is good. And you'll find a lot of companies with very high ROCE and all, but where growth vanishes, that ROCE ROE of no use. So till it is decent, it is good. And it is one of the best in the industry. And I see possibility of these numbers improving further, because right now they're working only on 70% capacity. So as they reach to prime capacity utilization, I expect these numbers to improve more and more. Also, they're able to churn their asset, because if you see a dairy business, basically it's all inventory churning business. You have to keep churning your asset, and the quicker you churn, the better it is. And that way the ROA is also decent. Then we saw where not to lose money. So it should have decent growth and opportunity size. So this is the history of company, and we will get into operations more, but I am just giving you a feel of financial, because whenever I analyze companies, those first level checklist has to pass. And if that is not passing, then I don't consider it as a serious contender for detailed financial analysis. So this is all those checklists. So sales wise, it's okay, 8-9%, but that is what has been also the industry growth rate. If you look at the fluid milk, it's around 6 to 8. And then all your value added product like your curd and paneer and all these are, and this market itself is 70-75% of market, rest is 25. So when you will do a 75 is to 25, and then the weighted growth rate, it will come around same 8-9 kind of percent. The company has done that, but the PAT margin, cash flow wise, PAT wise, the growth has been much more decent and much more higher. So they have done decently historically on 5-year, 3-year basis. And these are the industry projections for next, 4-5 years. And given they have been doing good numbers, if they can maintain the same number, then again, one can expect 9-10% kind of growth rate. But we will see more of that. Now, in terms of business model, so first, if we look at sector, and this is not a new sector for me, I have been tracking this sector for last 6+ years. Previously, I invested in 2 companies. The experience was good, made money. So I have to some extent, I have understanding of this sector, where to invest and also where not to invest, because this sector had a lot of big wealth destroyers. But I think I was prepared and all the decisions taken came out well. And I will discuss some of that. But this sector is also like in banking and all, we hear unorganized to organize and all. Here also some of that is happening. So I'm showing you 2 reports. This was the first very good report I read in 2016 on dairy sector. So when that report came, the share of branded private dairy companies was 30%. And then in 2020, this share has gone from 30% to 40%. And what happens? So in India, totally right now, India is producing rupee 4,30,000 crore of milk. And out of this, 50% of the milk is consumed internally, like, the houses, farmers which are having cattle, it's consumed for internal purposes. Sometimes, the cattle has to feed its, baby, and then the house itself consumes. But rest 50% is what is called marketable surplus milk. This is the milk which gets purchased in the market. Now in that, 50% is unorganized sector. This was in 2016. 50% is unorganized sector. So it's like those who have seen villages will know, the neighborhood house, they have a cow and they, produce milk and they sell milk to the neighborhood. So that is what the unorganized market is. But your organized market is divided into cooperatives and branded dairy companies. So your cooperatives are basically your state cooperatives. Like in Karnataka, we have Nandini. In Gujarat, we have Amul. So that way our cooperatives and branded players are the one which are non-listed or listed players in the dairy market. So we see some kind of shift which is happening to branded players, whether it's coming from here or here, but that shift is happening, and how that shift is happening, why that shift is happening when dairy is there, we will see. And the industry is supposed to grow at, same 10-11% kind of level. And the industry is divided into three products. So one is your liquid milk, the milk which we drink. That is the biggest one, almost a 70% market. Then you have traditional value added products. So this basically has your curd and paneer and all of that. So that is ghee, butter, that is traditional. And then your ice creams and your yogurts, which is very, very small market. This is the third market. So all these three combine and create this dairy market. Out of this, the lowest growing market is raw milk market. Then the next growing market is traditional value added products. And the highest growing market is emerging value added product, which is your yogurt and flavored milk and all of that. So this is how the market is. Now, Dodla, if you see Dodla's con call, they say that they have 7% market share in South India, but they don't quote any research report or any consulting report. They say based on our studies. So I wanted to do estimate. And if we look at it, liquid milk in India is 4,30,000 crore. 50% is marketable surplus. So your surplus becomes 2,15,000 crore. The organized share has gone to 40%. So 80,000 crore is your organized share. South India, this is my rough estimate because Northeast, Southwest 25% share, but East is smaller, South is bigger. And also South has better per capita income, and also usually there is always a correlation. The better per capita income houses, they will be more able to, spend on milk and those needs. So I've given 5% higher and taken 30% cut for South India. So South Indian market is almost South Indian organized liquid milk market is approx 24,000 crore as per my estimate. And if we look at Dodla's number now, so Dodla has 26% in VAP and rest is your raw milk. So on a 2,200 crore revenue, that comes around 1,700 crore. And when we see the 1,700 crore divided by 24,000, that comes approx 7% market share, which means their numbers are reasonable. Whatever they are quoting, that's a reasonable number, and we can trust it. Also, it validates all these numbers which we have collected. In some way, both things get validated. Now, before we get into Dodla, there is something very, very interesting to understand about this dairy business. So one question, if a company has to expand, the companies, they expand by geographies, right? We want the companies to grow the revenue. And one way to grow the revenue is by expanding in geographies, like typical FMCG companies we will see. In every state, they will increase the distributor count, retailer count, and all of that. What do you feel about dairy industry, or whether they should do geographical expansion? Any views? Feel free to, unmute and.
I think it is a bit difficult when it comes to dairy industry because unlike other FMCG products where you have to just increase the distribution reach, here on both end you need to increase the suppliers as well as the distribution. So I think it is a bit difficult when it comes to dairy industry. Just an like guess.
Perfect. So basically, it's a logistics business because you have farmer who is having cattle, and you have to collect milk. Then there are 2-3 levels where all this collection and processing and packaging and testing happens. And then there's a distribution link where so basically a dairy company on a daily level manages this whole supply chain movement. And just imagine about the amount of freight cost and, all the cost you will incur in moving this milk from one place to another. So, many of us in our, I think in our +2 or even in engineering or whatever degree we did, if we studied maths, operational research OR was a very, very important subject. And I think we would have heard about that traveling salesman problem, how in least of time with least of cost, he can cover all the location. So think that business like a traveling salesman problem. And it's not like I identified this. In 2018, we had this VP Chintan Bathak. And that time, Sumit Nagar was the chief guest from Malabar Capital. And if you track Sumit Nagar, he has been one of the initial investors in Hatson. I think he has created a lot of wealth. So he presented why he got interested in Hatson, and this is how, it got imbibed in brain. What kind of business is this? So basically, what these companies do. So let's say there is a company in Andhra. So the business model is you will have procurement to be done at a village level by collecting milk from multiple thousands and lakhs of farmers at a day on a daily basis. Once all this milk is collected, it is brought to a collection center, and then in the collection center, you combine, you bring all the milk, and then you take it to something called a chilling center. And this is where a lot of operations happen, the quality test happens, and all of that happens. And I'm not very sure in terms of process what happens first, but there are activities of collection, there are activities of testing, there are activities of adding some, some more things, do some processes like pasteurization and all. There are certain 32 tests which FSSI says to do on a daily basis. Then there are some fat content to be maintained, like we see the fat content. So certain processes to be done to, remove or convert that excess fat. So all of that happens at two infrastructure levels, collection center and chilling center, and then packaging. And then the whole retail distribution happens. So if you look at this whole business model, basically it's the dairy company, whether they outsource it or they do it through their own vehicle or whatever. There is a lot of transport cost which goes in managing this whole logistic and supply chain. So it's a man-driven, employee-driven, transport-driven, logistic-driven operation. And hence, it becomes very, very important that how are you optimizing your supply chain? Which means if you have started your operation here, how are you optimizing your, so one is your capex, which is going and setting up those collection center and chilling center. So the more milk you can sell through that capex, the more will be your asset turnover, and the more your asset turnover, the more revenue you will generate. But on the operating side also, the more milk you can collect by optimizing your resources, your location in a faster time at a least cost, the more revenue you will generate, the more margin you will generate. So it's a question of margin improvement and optimization. And if you'll see the P&L of dairy companies, freight cost is a big component. So of course, the raw material itself takes 75% of the revenue. But the next big item is freight cost, which is almost 7%, then your employee cost, and then packaging and all. So freight, packaging, logistic, these are big expense items. And hence the optimum cost metric in a dairy company is very important. And that is the reason this is a dangerous sector. You find a lot of wealth destroyers because the companies have to be efficient on a daily level for years and years, to get that 1% margin improvement. It's a very thin margin business. So that is the crux of this business. So you cannot expand by yahan bhi khol liya, yahan bhi khol liya, yahan bhi khol liya. And companies, those who have done that, they are the companies who have been less efficient and they got punished. Their numbers went bad and the market thrashed them. So it's very important to look how the company is expanding. And that is how Hatson has done. They first optimized Tamil Nadu and then they expanded. And this company also seems to be doing well, whether they are a copycat or whatever, but they have been on those lines. It's evident if we look at their growth, their P&L, we hear their commentary. So it's a regional business. That is why dairy is a regional business. And scale and concentration of direct procurement is important. Now, this word direct is very important because many times we hear why MNCs can't get into this business. In this business, you need to set your relationship with the farmer because he is giving you the raw material. And many times, many companies, they have agents who are intermediaries between the dairy company and the farmer. But the agent will take a cut. And just imagine if you are working in a 3% margin business, even if agent take a 0.5% cut. So it is dream of dairy companies to build 100% direct procurement network, and they strive to work towards that. So that becomes very important. track record of growing direct procurement with happy farmer, happy customer, and happy shareholder. Happy farmer because he's going to give you a raw material and it's a cutthroat market. You compete with the cooperatives also. So how do you keep your farmers happy? And cooperatives, they always get certain advantages because many, like in Karnataka, Nandini gets almost 2 to 3 rupees subsidy from the government, and 3 rupees, like, it's a big amount. So how do you keep your farmer happy when your cooperative can give some discount? Happy customer because every day you have to serve milk and the milk quality should be good. दूध फटना नहीं चाहिए. बार बार हम देखते हैं दूध फट रहा है तो वो रोक देते हैं. So that means how is your quality of your supply chain, that would decide if the customer is happy or not. And then happy shareholder because ultimately you have to generate money if you are a listed company. So ability to grow beyond home state. So ठीक है, one state you captured, but whenever you go to a new state, it's a new story. Again, you have to build those farmer relationships. Again, you have to understand the consumer. So there's another thing I didn't talk about it in, I think, IAS, but there's a buffalo milk and there's a cow milk. I don't recollect, but I think South works more on the cow milk, North works more on the buffalo milk. So there are a lot of little nuances when you go to different states, and how do you capture it, and how do you work, how do you build again the whole logistic. So it's like even in hospital, being a regional player versus being a national player. So if the company is showing the ability to grow beyond home state without diluting the first 2 points, and then comes your sales and distribution and your distribution reach and brand equity. And then because, the raw milk is still a higher single digit, 8-9%. So if you have to grow at a higher rate, you have to enter into the VAP market because that is where you get higher growth rate. That is where also in some cases you get a higher margin. So we'll discuss. But how the companies are identifying, and you see many new products coming, this flavored yogurt, flavored milk and all getting launched. So how the companies launch new products, this is the typical FMCG part of the business. So if a company is able to do all of this, then that is the company which will succeed. I'm just showing you how Dodla Dairy is doing here. If you see right now in Rajasthan and Gujarat, they don't have much of procurement. So it might be more like a testing market for them, and maybe later on they will enter with full force. But if you see Maharashtra also, it was not there, but they have already set up a 1 lakh LLPD capacity. So Maharashtra, now you have it. And it's present in international also. This contributes 5% of revenue. We'll see more about it. Now coming to value added products. So that is the another interesting thing about this industry. Whenever we think of value added, our understanding it, this is a high margin business than the base product, which is also the case in dairy, but there are certain subtle nuances. So if you look at a business like ghee is a very working capital business, high working capital business. So low margin. So margin bhi nahi hai. And no, where is fast moving, bro? No, there is low shelf life is okay. High capex. There are certain businesses which are high working capital businesses. So pouch milk is negative working capital. So basically you get your money in advance. It's low capex, fast moving, but least margin. If you go to cheese is a slow moving product. So here your works, even though your margins are very high, your working capital cycle is also very high. And then B2B becomes a bigger market, which means B2B means you have lesser pricing power. You can't. So it's not like all the value added products, they are better than milk. And that is where some of the companies like Parag and all came. Some of those companies, I remember they were heavy on cheese business. They were heavy on B2B business. So when you are looking at a dairy business, it is very important to look whether it's raw milk versus VAP. What is the share? Even in VAP, what is the concentration of revenue in each of them? And then whether it's a B2 business, B2B or B2C business, all of that. And then you get a better view of which company is bigger, and take this sheet as, a guiding sheet in terms of understanding from CapEx perspective, from margin perspective, from, working capital perspective, which are better. And Heritage con calls also have similar kind of discussion. My understanding was milk is a decent business. Curd is a very good business because it's a higher growth business. It's a high margin business, and still it requires low capex, and still it's a fast moving product. So this is the best business. Milk is good business, but something like a cheese is the worst kind of business to be in, and he is also somewhere in between depending on how the companies are doing. So though it's fast moving, of course, it's not like milk, but the margins are almost similar to milk. So this is how you should look at it. The other interesting thing about this sector, as I said, this sector had a lot of wealth destroyers. So Hatson has been a big wealth creator. Heritage has also created very good money. In fact, if you look from 1990s to 2017, Heritage had a very good return for its investors. But I think they tried to expand and they tried to open a retail business. So they opened a retail chain business, tried to divert, as I said, tried to get into too many states with retail, and finally they felt they couldn't manage it, so they decided to sell their retail business. So what they did is they did a deal with Kishore Biali. This is 2017. I have tracked all these companies, and the bad thing which they did is they didn't do a cash deal. So they purchased Future. They sold their retail stores to Future Group. They made the deal in two ways. They purchased Future Group shares with some contracts, and they got some specific terms and conditions where Heritage Milk will be sold in all the Future Group retail stores which we had, and we know what happened to Future Group. So वो share भी डूबा, वो retail store भी नहीं है उनका, वो भी गया. So basically they had their lesson, and now again they are focusing only on the milk part. But if you see, after Hatson, Heritage was the next good company, and still if I needed to invest, if we get Heritage below 0.5 price to sales, that is usually a good time to invest. That is where the cycle turns. These three companies, there were issues. Quality, though, I had discussions with my friends. Some of them, they knew the CFO. They told we will connect, but the balance sheet was so bad. I think I have all the notes. It looked it is bound to fail, and it happened. These two companies, as I said, more B2B, more cheese and those things, and that is why you see why Ambit had rated lesser compared to a Hatson. So many times we discard these kind of reports, but to get a business sense, some of these reports are really good, and actually this is what played out. So Hatson, basically it's the best player. Keep the valuation thing aside and the aggressive growth mindset aside, but the kind of supply chain, the kind of procurement, the kind of farmer relationship which Hatson has built, and I will show in the numbers. It's not only we are talking, it's evident in number, and not revenue number, but the operational numbers. So it's a tricky business. You need to find the efficient players at decent valuation, and we need to stay with the efficient players, because inefficient players, they will grow at any cost. The P&L will look good, but within 4 or 5 years, it will haunt. So that's very important. Now, given you understand the sector and the business model nuances, let me come to Dodla Dairy now. But any questions so far? Or we are good? Shall I proceed? Okay. So in Dodla Dairy, so in South India, it is the third highest player with 7% market share. Relatively newer company compared to the Amools and cooperatives and many private companies. It was started in 1995, and they have done well. They are present. They have almost I think 22 lakh liter per day capacity of milk. Currently, I think they're doing somewhere around I think if I remember 14. So that is why I said they have very good capacity still there. All they need to do is they open more chilling centers. So the capex of chilling center is not that high. And then third largest procurement network, and some numbers present in both normal milk as well as the VAP products, present in 4 states: Karnataka, Andhra, Telangana, and Tamil Nadu. Now expanding to Maharashtra. Also, they have some business in South Africa, in 2 countries where they have 5% revenues coming. And this year, those countries have also done the break even. Business model, you understood it, so I'll not spend time, but I will highlight what Dodla does for this. So they have tie-up with VLCC, and they have tried to use all the GPRS. So basically, Hatson was the first company which started doing it. And then I think Dodla has tried to follow it. But they try to ensure that all this tracking happens, so that supply chain is robust, the farmers get their money on time. So Hatson pays money within 10 days to all the farmers, and everything is automated, digital transaction. Dodla says for 88% of the farmers, they have been able to do it, and they do in 10 to 15 days with a little bit of lag compared to Hatson. And this is the share of VAP, which you see slowly it is growing. Every year it may not be continuously growing, but the trend is towards positive side. 2020 was an exception. So now if we look at the strategic view of the sector, procurement from villages is a very important business process. Milk chilling and dairy processing is an important process. And then your sales and distribution is an important process. So in procurement, the success factors are relationship management with farmer and share of direct procurement. Also touch points with the farmer. So is it like you are just buying the milk, or you have created a strong bonding by multiple touch points? And I will talk more about touch points, but the digital payment is a strong touch point. Removal of the agent and direct interaction is a strong touch point. Then for these farmers, they have cattle, and cattle, then they eat something called a cattle feed, which farmers buy. So if the dairy company themselves are providing cattle feed, that becomes another touch point. And then farmer doesn't need to buy, this cattle feed. You are selling milk and you're buying cattle feed, and the transaction, that gets auto calculated and net payment happens. So, all hassle removed. So these are various touch points by which the private companies are trying to break the barrier, and they're trying to create, some kind of connectivity with the farmer over and above how a cooperative does purely on the pricing basis. So that is how they are trying to do. And the more a company does, the better it is. So if you look at Dodla, last year they had 1.09 lakh farmers. This year they have 1.21 lakh farmers. So this number has to grow in double digit for all of this to happen, with direct connectivity, with more touch points, with more cattle feed and all the things. So this is where Dodla stands. Now, next comes this part of the business, how to gauge success factors. So the supply chain efficiency. How do we gauge supply chain efficiency? So your location efficiency, your expense to revenue, your margin optimization, your freight cost optimization, your asset churn capability. So we have to see if the company is growing too thin in all the states, or the company is focusing on a particular state. And then what is their revenue? What is their freight cost by revenue? Is it very high or is it low? What is their employee to revenue? Is it very high or is it low? What is their asset churn ratio? And then how they're growing the chilling center and collection centers. So all this will tell us who is more efficient. And then comes your sales and distribution, where your typical distributor count and retail parlor count and all of that. So they don't invest a lot on marketing. Their marketing cost, even for Hatson, it's 0.3, 0.4%. They open retail parlors, which becomes a visible brand, and they try to sell through it. But one idea is to promote their brand. So if we take Hatson as a benchmark, because they have been the pioneers of this model, challenging the cooperatives and able to grow, and then see where a Dodla does, what a Heritage does, just to identify and show by numbers why I feel Dodla is a better player than all others, and next to Hatson. So if we look at procurement, Hatson has 3.5 lakhs farmers, and if we look at the revenue Hatson is generating on per farmer basis, it is 1.2 lakh. 1.82 lakh revenue rupees per farmer. Dodla is a company which is by revenue 1/3 and even by farmer count 1/3 to Hatson. And despite of being 1/3, they have been able to generate 1.7 lakh revenue from each farmer. If we see the same number for Heritage, this number for Heritage is just 90,000 rupee. So Heritage is just half of Hatson, and Dodla, despite of being almost 80% size of Hatson in terms of farmer count, they are 50% away in terms of revenue collection efficiency. Whereas Dodla being 1/3 of Hatson, they are almost close, 85% close to Hatson in terms of what productivity Hatson has achieved. So this is how we have to take the business operations, understand the operational strategy, and then look at the financial number and blend the financial number and the operational number, and then try to understand strategically who is doing better. So this tells that Dodla is relatively better than Heritage, and they're trying to, whether replicating or whatever, but they are trying to do what Hatson has done. If we look in terms of supply chain, so here the trick is, as your size will grow, you will get the benefits of optimization if you keep executing in the same manner by extracting best out of your concentrated geographies. So if we see here for Hatson, freight forward cost is 4% of revenue and employee cost is 1.6% of revenue. Right now for Dodla, this number is higher. It is 7% and 4.2%. Now, one way to say is Dodla is inefficient and that is why it is happening. The other way to say is maybe as the size will grow, this number will keep on reducing, and that is how the operating leverage will play out and the margins will improve. And if we look at last 5-6 years, this is how it has happened. So I won't comment. Looking at history, it looks like it's improving and there could be scope, but this is what we need to track and see if this kind of improvisation is happening or not, or is the management taking too much of salary. And if we look at Heritage, their salary cost is almost 7%. So this is again almost 90% similar to Hatson, but 1.6% salary to revenue versus 6.7%. So either they're inefficient or they're taking too much of salary. I don't know if it is because of being from a political family or whatever, but I'm just putting the numbers here. Even for Dodla, it is in mid, but this is how we have to track. And then finally, if we look at the core EBITDA margins, this is where Hatson is at the highest margin. Dodla is somewhere in the middle and Heritage is at the lowest end, despite of Dodla being 1/3 of Heritage and Hatson, and Heritage being almost 80-90% close to Hatson numbers. So again, Dodla looks better than Heritage. Now, in terms of quality, so Hatson does 45 phases of testing, where FSSI asked for 32 phases. Dodla, when the IPO came 1.5 years back, this was 18, but in the latest annual report, they say that they do 27, but still, there are 5 less. So this is something which we need to ask from the management, and they should gradually improve. But all this quality will ultimately lead to happy customer. Heritage, I tried to search, but I never got this information on the quality testings which we do. So finally, if you look at the business model and the strengths of Dodla, procurement, direct procurement, money is paid direct to farmer for 88% of the farmers, direct procurement, and within 10 to 15 days, compared to Hatson, where 100% within 10 days. They have also auto-enabled the whole logistic through GPRS tracking and all. The supply cattle feed. So for Hatson, this is a big thing. Dodla, they started with a small setup, and their current capex is going here. That will increase the capacity by 6x. So one way to look is just from a P&L perspective, what is the revenue growth which will come through that? But it's not only about revenue growth, it will also help in creating a stronger bonding with 6 times more farmer. That is how we should take at it. Again, we spoke about touch points. So other thing which this company does is, so they have a group of veterinary doctors. Through those doctors, they organize training camps for the farmers, and then they help them with the ailment of the cattle, and also again increasing the touch points. Then facilitating sanctioning of loans from regional banks to invest in cattle. So all these are various touch points. And when all the transactions are digitized, it becomes easier to go and show the cash flows of the farmer and get a loan. So these are ways to build stronger community of farmer and, build, which will help in the whole logistics and supply chain. Supply chain, we know they're focused in geography and slowly they're penetrating. And then they have a 25 year of execution history. And through the numbers of operation and finance, we try to see how efficient they are. And then marketing and distribution. So it's a pure B2C company. Hardly 5% business is B2B because of certain reasons. And they don't want to grow any B2B. Even the question was asked. So they told we have taken a conscious call of being a B2C company, which I feel is the right strategy given how some of the B2B companies have done based on the margin pressure and all. And then they have proven in one of the toughest markets. So Karnataka is one of the toughest market because Nandini does a very decent job here. And also Nandini gets 2 to 4 rupees subsidy. Despite of that, they have been able to create a market in Karnataka. And if you go in North, the cooperatives are much more poorer in terms of management and all these things. So North has higher share of private sector players. So if they have done well in South, I don't know when they will expand because, it's your balance sheet and your P&L should allow to expand if you are somebody who respects return on capital and all. But whenever that will happen, they have worked in one of the toughest markets. So hopefully they should do well. In terms of management, so he's the person who started this business, Sunil Dodla. And Mr. Venkat, he joined him in 1997. And since then they have been together. So the The CEO has not changed, and he looks more from a strategic perspective. He's the operations guy. So this is a basically two-member team which has grown the business. You will see a lot of PE funds because there were 3 PE funds which came. So they have done almost 3 rounds of PE funding. One PE fund left, next came, like that. And even this current IPO which came, it was more a OFS, where the idea was to give partial exit to one of the PE funds. And the PE fund was still there. And the current selling which you see happening in the market, basically it is the same PE fund which is offloading more. And basically most of the selling is being consumed by institutional players. So your Plutus and your Oaktree and all, these are the institutions who are buying. So a promoter-driven company with strong, long bonding with the CEO, building business from scratch. Public history yet to be tested because 1 year is too low. I've gone through all the interviews. Looks like a decent person, talks logical. 1 or 2 places where it was a little tricky, maybe because he had to give exit to his to his investors, but still he spoke about able to maintain the absolute profit, and he has been able to maintain despite of margin contraction. But we need to give more time to see how they are to minority shareholders. Now in terms of wealth creation, so ये तो हो गया कि अच्छी कंपनी आइडेंटिफाई करना ताकि पैसा नहीं डूबे, बट पैसा बनता कब है? So the best of the money and all that multi-bagger that happens, and I think in our group we keep discussing the API sector bottom margin pay and all. So whenever we are able to pick companies at the bottom of the cycle, at the bottom of the margin, with a possibility of margin expansion, possibility of top line growth for next few years, and the valuation also, there is some possibility of re-rating, and then there's a continuation of execution track record, and the macro scenarios are conducive. So I just want to give an idea of how to pick and choose company, if we have to rate company, how we should do it. And if we can quantify all of this and then say we have 5 opportunities, but this is the opportunity because we have a margin expansion possibility. We have, so again, if we see rate gain, I know it's a high growing company, but the valuation is the piece where I am still not sure. So if we have to rate companies, this is how we should see, and companies which have all these possibilities ticked, those companies will create higher returns if things go right. And of course, macro situation need to be good, else the whole market will tank. So if we look at Dodla, so the upper chart is your annual PNL and the lower one is your quarterly. If you see annual, this business is basically forget this 12%. It happened because of certain things in COVID. The margins went up again. So basically the procurement cost went down, and because of that, and they had already had a price increase, so they got that bump, but that bump was not sustainable. And now the reverse cycle has happened. So from the sustainable margin was around 6 to 8%, but you look what has happened from 11% to 8, 8 to 7, 7 to 5, and then it looks like reversing. And this happened because of multiple reasons. So when the Horeca opened, the restaurants and hotels, they opened, all of a sudden, post-COVID, all of a sudden your milk demand went further up. And then, because of that, you had limited supply. So the raw material price, farmers, they increased the price, plus some cattle feed, big disease happened. So there are a lot of mass cattle disease happen. So, when your cattle will die or less cattle will produce milk, again, there is a contraction in the supply. So again, the prices will go up. So these things keep on happening. Plus the crude prices went up. So when the crude prices go up, your petrol cost goes up, then your freight cost goes up. So all of that has played. So from the best margin, within a year, they have gone through the worst margin. And this is, if you see all the players, you'll see similar kind of trends there. And now seems to be margin is, reversing. So I think, yes, we are at almost the lowest possible margin. I see that possibility. And now it is reversing. If we look in terms of future possibility, so as I said, this is the benchmark we have to see, and this will not happen in 1 or 2 years. I think even in 3 to 4 years, if there is 1% margin improvement, a business which works on 5-6% margin, if they go 1% more, that's like a 15-20% improvement. So we should expect that to happen over 4-5 years if they keep on executing. But these are the expense items from where the improvement should come. And even in the freight, some improvement should happen. So there is a possibility of margin expansion, but not much. Like they might go to 9%. Beyond that, I think they really need to, grow with the scale and be more efficient. So maybe 1% still margin scope of margin improvement is there. Top line growth we have seen. So this is the history. This is the future. So the industry will grow around 8 or 9%. This is how the company has grown. And if we look at the con calls, they say that they have been able to grow 10% by volume and little by value, because every year milk prices go up by 2-3% inflation, and that is how they grow. And they're giving similar kind of growth numbers. And even if we look in terms of where the capex will happen, so they have almost a 60-70 crore capex plan. And big part of that is going in cattle feed, because the raw material, the milk business already they're at 70% capacity. So they can do a 2,800 crore, on the same kind of capacity with little bit of, chilling center addition and all. But the big capex is going in cattle feed, where they're increasing the cattle feed from 2,000 ton capacity to 12,000 ton capacity, 6x. So total will become 14,000. And this 2,000 ton capacity has done almost 30 crore in half year. So 60 crore in full year. So 6 times 350 crore is the kind of revenue which will come from here, and the milk which will grow. And then some capex in milk they are doing in the South Africa. And if you see, this is the cattle feed business, and this is the South Africa business. And most of the business, they have done a break even. So now all the businesses are profitable. So with more capacity, more expansion, hopefully this will generate more profit. And the maintenance, so why very high free cash flow? So when you look at the maintenance capex now, this business doesn't have a very high maintenance capex, hardly 15-20 crore of maintenance capex. So they're doing almost 150 crore of cash flow from operations. So if you assume no growth, basically it's a 125 crore free cash flow generating business available at 2,800 crore. But given it will grow at 10%, and that 10% growth will require, 20 crore of maintenance capex and maybe 20 crore of additional new growth capex, still with a 10% kind of growth, you will get 100 crore of free cash flow, which means you are paying 28x free cash flow. So how many businesses which we get, at this? So that is what created my interest. And my view was, if we can get this business at 20 times free cash flow, nothing better than that. So 400 is the kind of price I have kept where that number happens. And technically that is where the last big bottom on the chart happened. So, everything inside. So that is the idea. So that is why I have started accumulating at the current price. And the idea is the price falls, I will accumulate with the idea of going full invested at around 400 rupees, where I can expose a good 4-5%. These are the kind. Only one thing is management history is not very long. That is the only thing which stops me from exposing full like 5% allocation. Else at 400 rupees, if that trust or confidence is there, I think that's a decent price to go fully invested in my view. So 10-15 crore of maintenance capex, all this is the point. And risks, so few quarters of listing history, as I said, it's a cutthroat competition industry in low margin business. So execution is key, and you cannot go wrong 1 year. Every year you have to keep, every day you have to keep executing. Crude price impacting freight costs. So, that is also impacted, but, if it will go down, it will work in the benefit. Raw material cyclicity, procurement, raw material cyclicity, it always happens. And when some disease and all happens, this gives a big blip to the price, and you will see the margins, contracting. African business related risks. So macro wise, Africa is a country where we don't know much what is happening. Currency risks, those kind of risks will be there. Then this stock has been more illiquid risk, and supply pressure is there, especially when this TPG is trying to sell stake. Good part is because the big institutional guys have started nibbling it. You don't see much fall in the price, else the prices would have fallen. And right now the technical momentum is missing as of now. And Amul and Hudson, they have given and they will continue to give tough competition. So if we see balance sheet cash flow 4 out of 5, valuation wise, I think it's fairly valued, if not very attractive, 3. And that is why I said I would wait maybe a 450, I will add more, a 400, I will add more. So that is why a score of 3. Decent business model. I think if they're able to match Hatson number to a certain extent compared to all others, there is something strong in terms of execution. And now we know how we should, track these companies. So a decent 3. Clean mid, because the guy seems logical. Last 1.5 years has been okay, but we need to track more. Margin wise, I am giving 4 because I think 5% was the worst margin. It won't happen. I mean, the other players are less efficient, so they will face more challenges. Growth wise, I see the possibilities. They're doing the capex 10% growth rate. They have grown at a higher rate. All the capex is in place. So yes, bottom valuation wise, as I said, okay, 3. Execution, very good track record. I liked what he has done. Macro, don't know much. So yeah, that is the whole presentation. Now I open it for questions.
Uh, Hi, Saurabh. I have few questions. First thing is, if I look at the sector, then the cyclicity is at the supply side, not at the demand side, right? So demand side is more of a structural or I can say a constant, because these are the daily necessity, right? So the demand side, there is no cyclicity is what I can see, but whatever cyclicity is there, that is at the supply side, right?
True. And in this case, because they're not in B2B for sure, else in B2B, there could be some demand cyclicity, but B2C, more or less, it doesn't look like.
Okay. If you can go to the presentation, I
There could
have
be a
few queries.
seasonality, but there is not much cyclicity.
Okay. Yeah. Can you go back to presentation?
Yeah.
Yeah.
Which side?
Uh, 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 yeah, 27, slide number 27, not the 27, 26, one slide before this. Right. So here in the procurement, you have mentioned that it is 1.82 lakh revenue per farmer. So is it something that we, like, you have calculated using like how many farmers they have mentioned? So here they have mentioned 3.5 lakh farmer,
Yeah.
and you simply divided the revenue by the total number of farmers
Yeah.
that are there.
Yeah.
Okay.
And
Okay. So this is
these numbers are there for 2, 3 years. We need to manually go and pick from annual reports and all, and then do it.
okay. And in supply chain, there I can see that in case of Hudson, there are 3.5 lakh farmers, but at the procurement end, they are having 1100 active bulk coolers, whereas in case of Dodla, they have 1.2 lakh farmers and 110 chilling centers. So is there the difference
Yeah.
in
Yeah.
the way these two companies?
Yeah, so I think I also noted this point, and my understanding is there are 2, 3 kinds of devices. There are chilling center, there are active bulk coolers, there are collection centers. So my sense is they are little different, and I think one of these discussions is there in the con call. So the kind of all the work which needs to be happening, some people they do it through ABC, which is active bulk cooler. Some people they do it through collection and chilling center. So that is why like to like this comparison is little difficult. So the better way to compare is how much of capex has gone, whether you are going with a collection plus chilling center combination or you are going with the active bulk cooler plus chilling center combination. We have to look at the total capex done, but comparing this number may not be apple to apple. But I also want to ask in some of the con call, what is the difference between bulk cooler versus this, and why the competitor has 1100 versus you have 110. So that is a
So
question.
as I remember, yeah, right? So I don't remember exactly where this I heard this discussion, but in case of Hudson, what I've heard is they do not. So at the collection center only, they have kept the bulk coolers. So it is not something that they will collect the milk first and then it will go to their chilling center. It is that they collect the milk and put it there in the bulk cooler only, and that is why they are efficient in terms of
Yes,
freight
in the
cost and
annual
all. Is
report, now search for this word active bulk cooler. There are 4, 5 line statements around why they do it. So I think what you are telling is maybe that is what they mentioned. I also remembered reading it. They have given the idea behind what is the USP of an active bulk cooler.
okay? I'll
So
check
this
that.
is
I'll check
something
that.
operationally, where we need to dig and ask Dodla management why Hudson is doing in a different way, or what are the different operational differences and pros and cons. This is a good question.
Okay.
And I don't
That
know if that has an impact on the freight cost also. So I think we should relate with the freight cost also, and then see how it impacts the cost economics and the quality economics.
yeah. That's all. That's all, Sarubhai. Thank you for the
Very good questions.
presentation.
Yeah, very good questions.
Thank you.
Other
Yeah. One last question. Sorry.
yeah.
Can you go to the next slide?
Yeah.
Yeah. So if we look at the numbers from 5 year and 3 year comparison, right? So there is not a big difference in the sales, right? But as we go down on the P&L statement, right? So the difference is increasing, right? So EBITDA is same, right? But EBIT has increased from 17 to 24%, right? So and again the PBT, it has grown. So if we go down the P&L statement, the there is a improvement, like more improvement in the different types of margins. So do we know what exactly has happened over here
So my
for
sense
these
is
type of numbers to grow?
from your sales to EBITDA, there is an operating leverage play which is happening because on the same employees you keep on growing. So there is an operating leverage on the freight cost and all of that. But EBITDA to PBT, what is happening? If you remember the balance sheet 5 years back, they had a debt on their balance sheet, and slowly that debt is gone because they have been keep on repaying loan. So I think because of that, there is an interest reduction would have happened. So that could be the reason why your PBT is higher than EBITDA. Now that EBITDA to PBT, I think that opportunity is gone because now they are almost debt free. So it all depends how much of sales to EBITDA improvement can happen further.
But Saurabh, they are doing some capex also, right? Recent capex. So with that recent capex, does this 1 year number looks different? Because considering the capex there, so is it? We'll have to check whether it is with the internal accruals or they have taken again the date for the new
So
capex that they are doing for.
they are net cash positive, and 1 year usually, for these kind of analysis now 1 year number becomes very, very, it has a lot of noise. So usually I avoid looking at 1 year number. But if you see, I think they are still debt free. Yeah, very minimal debt is there because they have decent cash. If I remember, they have some uh, they have, yeah, see 82. I think they have 100 crore plus cash. If I remember, they have 150 crore of cash. They have decent cash. And most of this right now looks like it will happen through internal accrual only. So, yeah, you won't see much impact on the EBITDA to PAT. So, only thing is your
Yeah,
depreciation
only the
will go up, right?
depreciation would be
This will
there.
go up, but yeah, this
Yeah.
is a typical cycle which will happen.
Yeah.
And it's not like a big capex is coming. If you see, this capex will be what? Where is fixed asset? So yeah, it's very, very small. As I said, 40
18
crore of
crore,
capex
yeah.
will come. So 40 crore capex will maybe, 4 crore of depreciation, which is not much when you see a 140, 150 crore kind of, PAT.
So we are not looking at the drastic improvements in terms of the PBT and PAT. What we are seeing is the improvement in the top line and some operating leverage to play
Yeah. So
out
one,
considering.
10% top line growth, anything more than that, good. Second
Yeah.
is a stable margin could be 1% higher than the current one because of whatever happened. And then based on the scale, whatever operational efficiency they can get in and improve their margins, that would be like some, but that needs to be tracked over a period of time. So like, see, they were 3%, 8, 6, 7, 5. So some cyclicity is there, but gradually, let me just see Dodla's margin chart. Maybe, but there is gradual some margin improvement, which is happening in the business. Of course, every year there are some, some things will happen. But if you see this trajectory now, this also tells that, it's little on the lower side. Employee cost has been maintained. So we need to see, but yeah, worst to worst case, I believe 1% margin improvement should happen, which is a decent on when the business works on, 5-6% kind of margin.
Yeah. Thank you, sir.
It will be more a compounding story, but the business is available at 28 times free cash flow, and with all these capex, if they do a 200 crore kind of cash flow, basically it's right now they're doing almost 150, yeah, 145, 150. So if they can do 200 crore cash flow, basically it's available at 14 times cash flow with a very, typical debt free and all of that. Growth, I think the growth runway still it is there because volume wise that unorganized market is there. Then they can slowly keep. So this business cannot grow at a very high rate. That is the nature of the business because of operations. So I think it will keep growing at 10-15% rate and it will be more of a compounder. And we can get a little bit of lift because of valuation and margin improvement and all.
And sorry, I'm asking too many questions. One last question. Yeah. So for valuing this kind of a business, so it is like the metric that you are using, right? So free cash flow to price to free cash flow. Is it the usual metric to value this kind of business,
See,
or?
my view is if our assumptions are right, then most of the valuation metric will be right. If our assumptions are wrong, then most of the metric will be wrong. So P, when we take, if the margin itself is highly overstated or highly contracted, then P doesn't make sense. But if it is a stable growth company, and if we take a normalized EPS margin and normalized EPS, then it will work. So my sense is whatever metric we take, till we are normalizing the numbers and taking a reasonable one, it should be fine. But given this looks like a decent, stable 10% growth kind of company, the fluctuation happens in margin. So I'm trying to take a stable margin. Then I think even the normal, normal cash flow or normal DCF approach will work. And in fact, let me show you, I did a DCF also. That DCF also, I think it looked interesting only. Let me just open it. If we take a PAT margin of 5% and it's a negative working capital business, so most of your PAT gets converted. So this is your historical, PAT to cash flow conversion ratio. So on an average, this is the kind of, cash flow you generate that we can see here also. So you can see this has been throughout. So if you have this kind of cash flow, and this is the kind of, capex, I think the free cash flow is much higher. It was 93 to 100 crore, but let us say 75 crore also. If you just have this, and let me replace it here instead of this number. Let me take free cash flow. Just let me change certain things. Yeah. If we take pure free cash flow, which I think is higher than this, how I have taken average of B89, which is, so if you see here, they are deploying because this is the average, but now they have done that capex, the capacity utilization there. So you'll not have so much of capex. Basically, your capex, you see they're doing, 40-50 crore of capex. So this number will go 100%. So let's say we change this number a little bit, because these are all automated assumptions being made. Why it's increasing free cash flow. Sorry, capex number. Sorry. So this is the capex. Let's say if a 20% capex is more than enough. So 30, and this is your cash flow. And let's directly calculate. I'm just making certain changes for that free cash flow number to fall. Let's reduce it. Yeah, you reach 114, maybe 35, and you reach that 100 number. Let's make it 40. So you'll be doing almost 65 crore capex, which is happening, and 97 crore free cash flow, it goes here. So your DCF valuation comes around 358. Just on a free cash flow basis. If you do a exit multiple on cash flows, so in 3 to 4 years, if the business on an 8% growth rate, see, I'm taking 8% growth rate, 5% margin, whereas they're doing 6.5% margin. Still, you are getting this. Now, let's say if we improve the growth rate to 10%, because I am assuming my PAT growth is as good as my revenue growth, and margin from 6.5%, I take it to 6%. Then this number goes to 450. So 400 looks bottom to me, and then depends. If you give an exit multiple, so let's say if you give an exit multiple of 20 after 3-4 years, so they will do somewhere around 264 crore of cash flows. So if you give an exit multiple of 20, given the business quality, still you make 16% return. So that is why valuation metrics are very tricky. That is the whole reason of learning technical. See, only at the extreme, all the metric will say it's a buy, but yeah. And that is why I'm not Gambo and I'm buying all 5% in one go. What if it comes to 400? But yeah, this is how you should take it. And as I said, it looks fairly valued to me. Maybe, if people realize the business quality, it should do well. But I am open to buy if there is more fall around 450, 400.
So in that case, Saurabh, you won't be looking too much at the technicals part of it, right?
So I will tell you, see, the thing is, usually I look technicals one more at peak selling, and I look at technicals in sectors where I have very less understanding. So pharma, if something bad happens, I get worried and I give more importance to technical, but this is a simple business to understand. So we should also understand why charts are happening like that. If charts are bearish, it always happens because somebody is selling. Now, if I can understand that sell-off is maybe because it's a IPO money, the guy wants to exit, I should be okay because it's a PE money, they want to exit, it's happening, some institution is buying. So that way I'm okay. So that is the reason here, even though technically it's not in momentum, and I know this PE fund is exiting, I'm okay with it, given it's a simple business to understand. But yeah, if there is a banking bank, if there is a pharma company, and then something like this happens, then I will be more cautious and maybe, I'll just sell it off. Or if the stock has already run up and then correction is happening, then I give all the importance to technical, because, when sellers are there, and there's the problem is at these valuations, you'll find buyers in the market. And that is why maybe a Oak Tree is interested, or a Plutus is interested. But when your stock runs up, it's already at 30, 35 valuation, and then somebody is selling, not many big institutions might be interested to buy, because they have to also make 20%. And from a risk perspective, from that valuation, making 20% becomes difficult. So it doesn't find buyers, and then the stock, keeps on tanking. So at which stage of the price movement and at what complexity of the sector, we need to give importance to the technicals. I think we all need to evolve and, create our own standards where we want to give more importance or less importance, being a techno fund investor.
Thank you, Saurabh bhai. Thanks for answering every question.
Yeah. Other questions?
So technically, Saurabh, does it look like it's kind of done with the bottom and probably from here going up, or
I don't see much direction. Let me show you.
Q3 is usually slow quarter, right, for dairy products?
Q3, that seasonality, let's look at the numbers, quarterly trend. This is the Q3. Revenue wise, it doesn't look like, but operating profit wise, both quarters, December, there was some downturn. I don't know why it happened. But yeah, looks like margin wise, some impact, some seasonality is there in the margin in December, though revenue wise, it's looking more or less same. Okay. So I think this is a good view, which will give you an impact understanding of seasonality. And if you look at multiple companies in the same sector, you'll get an idea. Now, price wise, if you see, and let me plot this time-based volume bar. See, what is interesting is, I mean, moving average wo sab aap hata do. Basically, just try to understand the price volume, what is happening. See, IPO, most of the IPOs were overpriced, we know all of that, and it corrected, and you can see such long wicks. So, of course, ye girna hi tha aur wo gira. Now, what is happening? If you see recently, most of the buy, at least in 2022, in last 1 year, the big buy has happened in this range, right?
Yeah.
And after this range, the volume is totally dry. So my sense is that happened because in COVID, that happened because I don't know, but my sense is if it falls from here, you might see a quick fall here to here, because there is no volume, there is no buy volume here. So maybe the guys who purchase here, they will come. But ideally, the big buy is happening here. So ideally, the guys should support the price in this band, this 475 band. And how many weeks? This is a weekly chart. 1 week, 2 week, 3, 4, 5, 6, 7, 8, 9. Almost 10 weeks, this range has acted as a support.
Yeah.
And TPG, basically it's TPG selling and other guys buying. Let me just show you those numbers. Where is trend line? Yeah. Line, Dodla Dairy. So shareholding. So promoter is 62%. Dodla, it's okay. All that is done. Family trust done. Institution. So this sell-off is happening. I don't know why it doesn't show yeah, I think no. This is SBI and all. I don't know where is TPG public. Okay, let's go to screener. I think screener, some of those deals might be there. Yeah. So on 21st September, TPG sold Bharat Biotech. I don't, it's a Hyderabad company, so maybe the promoters know each other. But recently, again, when these guys were selling this Ashoka India purchase, Plutus purchased. So basically, it's Plutus, and then recently, I think Oak Tree has also purchased. So these are the guys who are buying. This is what I see happening. And if we see whether retail is buying, so retail is slowly selling. If you see retail's number of retail shareholders, of course, IPO is like everybody buys and throws it off. But from 60,000, slowly this is coming down to 39,000, and this is slowly coming down. And the supply is from TPG and it's getting nibbled by those things. And I have seen Plutus also buying. I don't know where did I see, but Plutus has also added recently. In fact, let's see the
Stockage, you can see it on stockage. Stockage पे दिख रहा है.
stockage पे है क्या? Okay.
हाँ.
Okay. Yeah, Plutus has entered here in September. So TPG is selling and these guys are buying, and retail is also slowly reducing. So technically, this is what I see here. I mean, it can break here. It can break, and if it can break, it can go to 400 also. And that is why I am also a bit cautious. Because see, if you see all this, no, it's a downward trend. Down, 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 down. Slowly, it's trending downward. This is where it has got support last time. And up volumes are higher, the down volumes are lower, but I mean, all the momentum is missing. I will not be surprised if it breaks this, but nobody knows.
Yeah, seems to have a good solid support.
Yeah, I think we need to find how much of TPG's stake is left. I think, and somewhere in the shareholding, I don't know why it's not coming properly. Let me see in ACE equity how they have given.
So nowadays, which stock is going to break when or go back when, just no idea. I was waiting patiently for Shivalik and RHIM. They were at the breakdown area. I thought they will go down, and then that's it. A week later, they are into the new highs.
This market is also very tricky. So some indicators which I have to track market, everything is in the middle from where it can go down also or up also. So I am also not doing a lot. Even the trades which I take it, I am trading with hardly 20% of trading capital, not trading a lot. Very tricky market. The stop losses need to keep it much bigger because small stop losses are getting hit like anything. Lot of false breakouts and all of that.
Yeah, too many false breakouts.
Yeah. With lot of heavy heart today, he took some position in HCG. Looks like, breakout is there. It's reversing, margin story is there. But God knows, yeah, most of the charts they do. And it's not like it's a breakdown where, they keep coming down. It'll come down the moment your stop loss gets hit, again, it goes up. That
it goes back up. Yeah, exactly. That's what is happening. That's why I'm now silent for the last 1 week, not doing anything.
Yeah. Yeah, now let's see the shareholding data. Holding more than 1%. Aditya Birla, BVK. Shareholding pattern. Okay. Institutions. So mutual fund is there. Foreign portfolio investor 8%. So it should be less than 8% for sure. I think we need to go to DRHP, see how much they offloaded in the IPO, and then we can do some reverse calculation of how much Plutus has taken, those have taken. That will need little bit of effort, but I think that's worth doing because we will know how much that is left. The moment, the thing is, the moment that cell gets consumed now, then the reverse will happen. So if you have a fair idea of tracking now, I think I will do that exercise. Okay.
Great.
Sir, can you go back to that screener?
Yeah.
Thing? Yeah. Looks like September, I don't see any. Okay, Plutus will, that is.
Plutus has added, and if we look at deals in September, this person has sold little bit, Sunil Dodla Reddy, but it's very small. I mean, it's point something, which is okay. TPG has sold the big amount, and Bharat Biotech purchased the big amount. So basically, Bharat Biotech purchased both the amounts.
So here, yeah, okay. So here, if you see in September quarter, there is no number, right? That does that mean like they've sold all their holdings?
Where?
TPG. There.
TPG,
Can you close
okay.
the-
Yeah,
because
there is
we-
lot of,
but-
there's lot of juggling which has happened in the screener data. And I checked with Pratyush, he told because the shareholding realignment has happened. So TPG is not a public. Ideally, that should get realigned somewhere. Okay.
But here, if you see like in
9.8.
September, but September, there's nothing here.
DSP, Aditya, this. Value, Ashoka, you are right. So IFC got shifted. IFC, यहाँ पे 4.46 I remember, yeah. So see, IFC went from DIA to FII. All that is happening. Steenberg was also there or no? But yeah, TPG is not there. So 9.8% is big.
FII stake increased from 4 to 13. That will include this one, right?
Let's go to NSE website. I think that is the best place to check. In the whole shareholding pattern itself, NSE, yeah. I hope they have all the names in right format and all. Shareholding. Somewhere there leaves no shareholding data. Information. Shareholding pattern. Where is the announcement? Dodla Dairy. No, this is a related party transaction. Sorry. Where did it go? Personalities. Can you see the menu? Oh, yeah.
There is something called corporate
Yeah.
information. Yeah.
Information. So, institutional investor, related party transaction, transcript, recording, newspaper advertisement, Mr. Presentation, and list call. This is October. Closure of trading window, institutional investor. Six months. Yeah. Stock presentation. Institutional call, institutional.
So which one you're looking for now? The original-
Shareholding, the industry, companies, they declare that shareholding data now.
Oh, that one. Okay.
Yeah, that raw format from where all these
Yeah. Got it.
websites
Got
they
it.
take it. I was trying to search that.
Yeah, that's usually in the corporate announcements. It should
I
come
think this is the
September, end
one.
of September. So October first or second or third week, it should be there if at all. I'm also looking at
July, December.
Hey, Swaram. Hello.
Yeah.
Saurabh, hi. I've seen the company's website also. TPG is not mentioned over there. In fact, they mentioned all the institutional holders also.
Looks like they might have exited then.
Yeah, I've just checked the company's website also. There is September quarter holding over there, and they're having all the names of Aditya Birla foreign institutional investors also, but it is not mentioned about TPG anywhere.
Okay. So might be they would have exited.
Yeah.
Foreign TPG will not come in institution.
And the company itself is saying that International Finance Corporation is a basically FPI.
Okay.
See,
Yeah, TPG was there. See, 2006 June it was there, and now it is gone. So this is the holding more than 1% public. It's gone, and who all have come here then? So 1.56 to 1.61, 2.7 is there, 1.14 is there. This is there. IFC has moved. That is why it is not coming.
Steinberg is there.
Steinberg is there. Plutus is there. I don't know why Plutus name is not here. Ideally, Plutus should also be there. So this is 2.5%. And then Plutus is there in public. So this is 1.27. So 3.5, 3.7%. And then this guy.
So TPG sold off on 1st September 2022.
Yeah, it's almost 8%. See, this is 3.41, this is 1.27, 4.41, 4.48, 4.6.
Yeah, so that's where Plutus and Steinberg got it. So I have this screen here on BSE sort of.
Okay, you can share.
Yeah, shall I share?
Yeah, you can share. So 4.6 and to 6.67, almost 7.3 is between these three, Steinberg and Plutus and that.
All of that happened on basically 1st September. If you see top 3 rows.
Okay.
But it doesn't entirely, the quantity doesn't entirely add up though. Maybe retailers would have probably bought it as well.
Yeah.
So
that's the state.
Done.
Yeah, that's the state on.
So, okay, then that's a good sign. So basically there is no more selling pressure.
Hopefully, maybe it's not there, so there should not be. Yeah. Until there's somebody, but we need a big buyer, to like what we saw today in we need some big buyer for that to happen.
Yeah.
Because so far these guys have only consumed what was, the big seller supply. So let's see. Then few guys I like, one way I track is the guys whom I respect from their knowledge perspective. I always try to search what con calls they're attending and all. So I really like Digant. I know Digant is famous for his bank and finance knowledge, but I think he's a very, very good analyst. So when I was researching this Vector Food, I saw him also there in the call. So that was also a good sign. It worked. I see him also in Dodla's con calls, which is good. So the other way is look where, the good guys are going, what they're tracking. So, these are ways to find interesting ideas. Many times we might miss it. So that's another thing I found.
So, Saurabh, on the similar lines, just wanted to ask how this particular idea came to your mind. Was it because you were invested in the dairy sector earlier, or was it under some technical?
Yeah, so I have a scanner for supports. Okay. So when I say I have a scanner for support, let me show you. And you will have all the companies which will keep breaking and keep going down. But my idea is just to see if any decent company is there. And that came somewhere there in that support scanner for the first time. There's a support scanner. You'll get all shitty companies which are, breaking and falling and all. But let me show you what I mean by support. So let us pick, I don't know, let's pick Neel Kamal. Now, if you see Neel Kamal chart, you see this area.
Your screen is not visible.
Oh, sorry. I think first time I saw it in that support screener somewhere. Like, let us say Bharat Rasayan. Now you see Bharat Rasayan. See, this area has been support, and right now also it's in the same price. So I built multiple scanners just to check. It's not like I will invest. It's just to check. अच्छा कौन सी कंपनी गिर रही है, कौन सी कंपनी पास में है, कौन सी कंपनी मंथली RSI के नीचे 30 के नीचे. The idea is just to check market में क्या हो रहा है. So somewhere I remember I saw Dodla, near that support region, and then the beauty of this Excel sheet is, so when you open the Excel sheet, you can see the whole story. So if you forget about what happened 8 years and min-max doesn't work because it's only 5-year balance sheet, these numbers look quite decent. Like first, in dairy sector, I have seen very few companies generating decent profits. So this company has throughout generated. Look at the free cash. Look at the, recently what has happened slowly. The big capex got over, but now as we are progressing on 75 crore last 3 years, 465 crore cash flow, only 165 crore capex. If you go and if I show you the other cash flow 2 statement, look, 5-year history. Now see what is happening. Earlier, lot of money has gone into capex, but now if you see the con call for this 10-15% kind of growth rate, the 60 crore capex is enough. No working capital in the business, and the debt has been repaid. They have paid almost 170 crore of debt and 87 crore of interest, but now they're totally free. So all of this is going to become free cash flow. So I like these kind of businesses in these kind of sectors, easy to understand. If you look at the return ratios, everything is lot of, I like consistency. See, bad companies now, they will do 1 year well, second year very bad. Good companies, they will be more and more consistent relatively. So, everything, all the things, when you look at it, you feel, there is something decent. So with that, then I think I discussed with Anish or somebody. So yeah, I discussed one more time with one friend who is an institutional investor. So I can't name him, but we discussed about these 2 companies, Heritage and this. So it gave a feel ki company decent. Then with that, I started looking deeply, and then, at least I had that understanding of how dairy sector works. So when you hear the con call and when you say that how he is taking these geographies, somewhere it touched that he is hitting the right chord. So, that is how it happened.
One more question, sir. Sorry. When we see the capex spend, right? So in case of dairy, is it because of the chilling center that they set up the capex? Okay.
So chilling and collection center, and if you go to Dodla's con call, you'll get an idea. One chilling center, what is the capex? So I think the number of chilling centers they need, that 10 crore capex was sufficient. So you have all the economics. I also need to put down everything in an Excel sheet. I have not done, but I took the broader numbers of maintenance and growth capex. Hatson will be little different. So Hatson is a very, very different model. They have ice cream parlors. They're expanding heavily. So I'm forgetting the name of the brand, but Ibako, yeah, Ibako. So Hatson is not only a milk business, and I wanted to get the detailing where I could separate the milk business with the ice cream business and all. But looks like they have placed everything in one business, so it's very difficult to bifurcate the numbers. So 100% apple to apple comparison between Hatson and this company will not be possible. If you try to compare with Heritage, then Heritage was a very different company before 2019, because there was a retail business, there was some power business, there was this. So you can compare only last 2 years of numbers. So, even though all the companies are in the same sector, to do an apple to apple comparison becomes very difficult when you look into these nuances.
Yeah.
Okay. So take it as a compounding business, but वही होता है यार, मतलब low risk businesses where पैसा डूबने का ज़्यादा खतरा नहीं रहे, मेरे को सब पसंद आता है. So take it like that kind of company, and of course I think it's doing relatively better. I like how they're executing it, but yeah, the public history we need to see. Okay. There is one more thing. So I think I have read almost 50 plus con calls, and I'm going to now upload everything because it's endless. I can't read more. So I'm going to upload all these con calls, and every con call when you will open, everything will be highlighted so you can get a sense. And I will record, a good 1 hour video where whatever we discussed, apart from that, whatever new insights I had, because we can't do so many, weekly calls. So I'll record that video and I'll put it. So that's additional content which will go. So just leverage it so that you know, you are better prepared in terms of what is happening on the market side.